Everyone has heard the whisper that foreign currency is an easy bet. People picture big overnight returns and headlines full of traders celebrating currency victories. The reality is rarely cinematic and often looks more like an expensive school of hard knocks. In this video, I will argue that currency trading is primarily speculation and not investing. By the end, you will know when exposure to foreign currency makes sense and when it is simply gambling disguised as strategy. First, we need to define what people usually mean when they say they want to invest in currency. Most retail narratives involve buying one currency and waiting for it to rise against another currency to capture profit. That premise sounds straightforward, but simplicity does not equal reliability or sustainable edge. I will demonstrate throughout this video why that straightforward premise collapses into speculation. The forces that drive exchange rates are complex, shifting, and often controlled by factors outside individual control. Currency markets are dominated by macro forces that no individual can consistently predict. Central bank policy, unexpected political developments, and global capital flows move exchange rates in sudden, unpredictable ways. Those are not small ripples, but tidal waves that overwhelm short-term traders without systematic advantage. Because of these macro drivers, currency trading without a true information edge becomes speculation. Retail traders often mistake volatility for opportunity when it is actually noise without durable predictive signals. Leverage is the siren song of the foreign exchange world, and it increases danger dramatically. Many brokers advertise small margin requirements, which magnify returns but also magnify losses in the same proportion. Leverage converts minor price moves into portfolio, obliterating events for unprepared traders. Compounding that danger are hidden costs like spreads and slippage that erode expected profits. Those frictions matter, especially when traders attempt to win frequently over tiny margins in liquid FX pairs. Another invisible risk is the informational disadvantage faced by retail traders against institutions. Large banks and hedge funds possess proprietary data, faster execution, and dedicated economists who parse central bank signals. Competing against those advantages without superior resources is an asymmetric mismatch most amateurs fail to overcome. Execution quality and latency matter deeply when milliseconds change prices. Retail traders also face limited access to hedging tools and complex derivative structures available only to professional counterparties. Psychology plays a major role in the downfall of many currency traders and their ambitions. Humans are wired to see patterns and to prefer stories that confirm hopes, which leads to overtrading and chasing losses. Emotions compound the mechanical risks and turn strategic losses into catastrophic blowouts. Successful trading demands disciplined risk controls that most individuals struggle to maintain consistently. When discipline fades, positions become bets based on hope rather than rational risk-reward calculation. If currency trading is mostly speculation, what legitimate reasons exist to hold foreign currency exposures? Corporations and exporters need to manage receivables and payables in different currencies. For those participants, currency exposure is an economic reality, and hedging becomes a necessary cost of doing business. Similarly, long-term investors with overseas assets may need currency management to prevent currency risk from dominating portfolio outcomes. The motive here is to stabilize cash flows and preserve purchasing power, not to chase short-term exchange rate moves. When does currency exposure make strategic sense for investors with international holdings? The answer centers on hedging to reduce unwanted volatility rather than speculation to generate returns. Hedged instruments can protect expected cash flows and returns when currency moves are uncorrelated with asset fundamentals. Another sensible use of currency exposure is diversification when correlations change during crises in predictable ways. That requires a systematic approach and clear objectives rather than ad hoc bets on currency direction. So what are better alternatives to active currency trading for most investors? One simple choice is to use currency. Hedged international ETFs, which remove exchange rate noise from equity returns. Those funds allow investors to focus on underlying asset performance, rather than attempting to predict currencies. Another alternative is to accept local currency exposure as part of diversification and rebalance periodically with discipline. Passive, low-cost strategies typically outperform noisy trading strategies after fees and taxes over long time horizons. For investors who still want active currency strategies, there are strict evaluation criteria that matter. First, verify a consistent edge that survives realistic transaction costs and frequent slippage. Backtests without realistic frictions often give a false sense of confidence and misleadingly positive results. Second, examine the risk management framework carefully to ensure drawdowns are limited and survivable. Many strategies look profitable until a single multi-standard deviation move destroys capital and leaves no recovery path. Third, insist on transparency about execution quality, counterparty risk, and funding sources before committing capital. Strategies that require exotic leverage or opaque prime broker relationships carry hidden tail risks. Investors must know who will be on the other side of their trades in times of stress. Finally, stress test strategies under extreme scenarios, such as sudden currency pegs, breaking, or capital controls being imposed. Historical stress provides limited guidance, but remains the best available tool for revealing brittle assumptions. History provides clear examples of how dangerous currency exposure can be when mismanaged. The 1997 Asian financial crisis saw currencies collapse and contagion destroy regional banking systems within months. Many investors who believed in stable fundamentals were wiped out by sudden currency paralysis and liquidity evaporation. Another stark example occurred in 2015, when the Swiss National Bank unexpectedly removed the franc cap, and markets moved violently. Retail and institutional traders alike suffered massive losses because leverage and assumptions about policy credibility failed simultaneously. Consider the Brexit episode when the pound dropped sharply and then partially recovered over years with volatile retracements. Traders who bet on a quick recovery without proper hedging lost heavily as markets priced political uncertainty. Even professional investors struggled to forecast the timing and amplitude of the moves. These episodes teach a simple lesson about predictability and survivability in currency markets. Unless you have robust risk capital and institutional-grade resources, speculating on policy-driven moves is risky and often unrewarding. There are also quieter examples where hedging paid off and preserved value for long-term investors. Pension funds that hedged currency on overseas liabilities avoided dramatic funded status swings during turbulent markets. Hedging allowed them to focus on meeting obligations without speculative losses, dominating the numbers. Multinational companies that implement disciplined currency risk policies protect margins and forecast accuracy. Those pragmatic uses of currency are fundamentally different from speculative attempts to outguess central banks or market sentiment. Building a real investment strategy around international exposure starts with clear objectives and constraints. Define whether the goal is to reduce volatility, protect purchasing power, or enhance returns before choosing currency tactics. Without clear purpose, any currency position will look like gambling dressed up as investing. Next, choose instruments that match those goals, such as hedged ETFs, local bonds, or using natural hedges through matching liabilities. Match the tool to the task, and avoid shiny complex derivatives unless you fully understand their payoff structures. Allocation matters more than market timing for most investors when it comes to currencies and international assets. Small systematic allocations to foreign assets, rebalanced with discipline, produce more reliable long-term outcomes than constant directional bets on FX. Rebalancing disciplines forces selling into strength and buying into weakness without guessing the next headline. Also consider tax consequences and cost structures when selecting hedged or unhedged instruments. Fees, wrapping costs, and cross-border tax rules can change the expected return picture significantly and should not be an afterthought. If you are still tempted to active currency trading, set strict limits on leverage and position sizes. Define a maximum drawdown that you will not exceed and an automatic plan for cutting exposure. Those limits are the guardrails that separate disciplined risk taking from reckless gambling. Maintain a trading journal that documents each trade thesis, risk, and outcome to force accountability and learning. Most losing patterns reveal themselves only after rigorous documentation and honest reflection of mistakes. Understand the role of costs and execution quality in any currency strategy you consider. Spreads, overnight swaps, and and financing charges accumulate silently and can convert small edges into losses over time. Successful long-term strategies either avoid these costs or generate returns large enough to justify them. When evaluating third-party managers, look for full disclosure of transaction costs and slippage. Transparency is a rare commodity in trading, and paying for it often protects investors from unpleasant surprises during crises. A common mistake is confusing short-term correlation changes with durable investment opportunities. Currencies often move together under stress, and correlations can flip without warning, making hedging models unstable. Relying on fragile correlation structures to generate returns without contingency plans leads to failure during crisis episodes. Robust investors plan for correlation breakdowns and build strategies that survive regime changes. That means stress tests, liquidity analysis, and conservative leverage, not hopeful extrapolation of recent patterns. If you decide to work with a manager specializing in currency, ask for clear performance attribution and independent verification of results. Many managers produce flattering net returns, while hiding tail risks in opaque derivatives or concentration bets. Independent audits and custodian statements are essential proof of what actually happened in past drawdowns. Also inquire about how the manager handled past crises and whether their playbook required extraordinary central bank conditions to succeed. Real skill shows through during stress, not only in benign market months. There are times when absolute avoidance of currency exposure is rational and prudent for retail investors. If you lack patience, capital to withstand drawdowns, or access to institutional resources, then avoiding active FX speculation preserves optionality. Preserving capital and buying optionality is a perfectly valid long-term investment decision. Similarly, avoid the urge to chase last quarter winners in currency markets, because momentum often reverses abruptly. Discipline and patience are the rare skills that compound more reliably than directional currency calls. To summarize, speculation and investing are not the same, and conflating them costs people money. Currency trading for directional profit behaves like betting on policy outcomes without institutional advantages. Hedging and disciplined allocation for operating businesses or long-term investors are the legitimate uses of currency exposure. If you feel tempted by quick FX gains, remember that surviving another day is the most underrated investment strategy. Compounding returns slowly and steadily often outperforms risky attempts to time and guess global central banks. Real examples taught hard lessons about unpredictability and the costs of leverage across decades. From devaluations to peg breaks and sudden policy reversals, currencies can move violently and without warning. Those historical episodes are not exotic nightmares, but practical reminders about tail risks in global finance. Learning from those examples means adopting humility and alignment with clear objectives. The world of currency is unforgiving to the confident, but generous to the patient and prepared. If you want to craft a simple personal rulebook about currency, it might include 3 items. First, avoid directionally trading currencies without institutional edge or robust stress testing evidence. Second, use hedged vehicles when protecting overseas investments or cash flows is a priority. Third, focus on long-term diversification and low costs because those choices compound more reliably. Rules are not glamorous, but they are the practical defenses between speculative hope and sustainable wealth creation. The philosophical twist here is that true investing minimizes anonymous risks and maximizes durable ownership of value. Chasing short-term currency moves embodies a different philosophy that prizes prediction over ownership and gambling over stewardship. The long arc of wealth building rewards those who accept small, boring returns instead of spectacular, one-off victories. If this reframing changed how you think about foreign currency and investing, consider subscribing for more deep dives like this. If this gave you a new perspective, hit subscribe. Practical next steps include auditing any current currency exposures and listing why those exposures exist. Write down whether each exposure is hedging a real business need or whether it is a directional bet awaiting validation. This simple act of specification separates considered strategy from wishful thinking. Then review alternatives, such as currency, hedged ETFs, or liability matching approaches before committing new capital. Often the simplest move is the correct one when it comes to currency and international investing. Finally, remember to keep humility as a central part of any financial plan, because the market will always remind you of what you do not know. Maintaining capital, optionality, and the willingness to learn are the most valuable assets for long-term investors. Currency markets will always be there for speculative gamblers. The wise investor chooses when and how to engage. If this video gave you a useful perspective on foreign currency investing, subscribe for more thoughtful finance narratives. If this gave you a new perspective, hit subscribe. Bonus checklist. If you are considering active currency trading, ask 3 simple questions before proceeding. Do you have a documented edge that survives realistic transaction costs and slippage all the time? Can you clearly demonstrate how you will survive a major policy reversal or a sudden liquidity freeze? If the answers to those questions are anything but a confident yes, you probably should avoid active FX speculation altogether. Following a humble checklist beats bold guesses when the stakes include your capital and future options. Remember that markets are competitive, and outcomes are a sum of collective beliefs, not guarantees of individual fortune. Currency markets reward information, execution, and risk management, advantages more than retail intuition or hot tips. Building durable wealth is an exercise in compounding advantages, not chasing headline trades. So before you place another leveraged FX bet, step back and ask whether you are investing or gambling. If you want to learn more strategies that prioritize survivability and long-term returns, consider subscribing for more content. Thank you for sticking with this deep dive into currency, investing, and speculation contrasted. I hope you now see why many currency trades are essentially speculative bets lacking institutional advantages. The safer path for most investors is clarity about objectives, cost, aware instruments, and disciplined allocation instead of directional currency wagers. If this gave you a new perspective, hit subscribe and join the conversation in the comments about how you manage currency exposures. If this gave you a new perspective, hit subscribe.